The truth about SBLCs, separating reality from the myths in standby letters of credit. Few financial instruments generate as much confusion as the standby letter of credit, or SBLC. If you spend any time in the world of project finance, private lending, or international trade, you will almost certainly hear bold claims about SBLCs. Some people say they can be leased. Others say they can be monetized instantly for massive capital. You will hear about trading platforms, bank instrument programs, and funding structures that promise extraordinary leverage. But the reality is far less dramatic and far more practical. SBLCs are legitimate banking instruments used by financial institutions around the world every single day. The problem is that outside traditional banking circles, they are often misunderstood or misrepresented. In this video, we are going to explain what SBLCs actually are, how banks really use them, and why so many misconceptions surround them. First, let's start with the basics. A standby letter of credit is essentially a bank guarantee. It is issued by a bank on behalf of a client and promises that the bank will step in and pay a beneficiary if the client fails to meet a contractual obligation. Think of it as a financial safety net. If a company fails to perform under a contract, the beneficiary can draw on the SBLC and the issuing bank becomes responsible for payment. Because of this structure, SBLCs are primarily risk mitigation instruments, not direct funding tools. They are commonly used in international trade, construction projects, infrastructure developments, and other transactions where parties want additional security before entering into an agreement. In legitimate financial markets, SBLCs serve very practical purposes. For example, construction companies may provide an SBLC to guarantee performance on a project. International suppliers may require an SBLC to ensure payment from overseas buyers. Infrastructure developers sometimes use them during certain phases of project development. In all of these situations, the SBLC acts as a guarantee of performance or payment. However, this is where the misunderstanding begins. In the alternative finance space, SBLCs are often marketed as if they are funding instruments themselves. You will frequently hear about so-called SBLC lease programs, where someone claims they can rent a $50 million or $100 million bank instrument for a small fee. In reality, this is not how traditional banking works. Banks do not simply rent out their balance sheets. Before issuing an SBLC, a bank must complete full credit underwriting of its client. That means reviewing financial statements, verifying collateral, performing compliance checks, and confirming that the client has the capacity to support the instrument. After all, the bank is effectively guaranteeing payment. This is why the credit strength of the issuing bank is so important. In legitimate transactions, SBLCs are typically transmitted through the SWIFT banking network, using secure messages such as MT-760 for the issuance of a guarantee. Even then, banks and counterparties still conduct extensive due diligence before relying on the instrument. Another topic that frequently appears in discussions about SBLCs is monetization. There are circumstances where financial institutions may lend against a high-quality bank instrument. However, these transactions are complex, heavily regulated, and subject to strict verification requirements. They are not the simple, instant funding solutions that are often described in promotional materials. Unfortunately, because SBLCs are complex and not widely understood outside professional banking environments, they have also become associated with a number of scams. Common warning signs include promises of massive funding with minimal documentation, requests for large advance fees, references to unverified banks, and claims about mysterious trading platforms that supposedly generate extraordinary profits. In reality, institutional lenders still focus on the fundamentals. They look at asset quality, cash flow, project feasibility, management experience, and repayment structure. An SBLC may enhance a transaction, but it cannot transform a weak project into a bankable one. The truth is that SBLCs are neither mythical funding machines nor inherently suspicious instruments. They are simply bank guarantees designed to support contractual obligations. When used properly, they play an important role in global commerce and structured finance. But when misunderstood or misrepresented, they can lead businesses down very expensive paths. Understanding the difference between legitimate financial structures and unrealistic claims is critical for anyone seeking serious funding. If your business is exploring structured financing, trade guarantees, or complex capital solutions, it is essential to approach the process with experienced guidance and realistic expectations. At Equus Capital Finance, we help businesses structure lender-ready financing strategies and navigate complex capital markets with clarity and discipline. If you are considering an SBLC-related transaction, project financing, or structured capital solution, feel free to reach out and start a conversation. The right structure always begins with the right strategy.